In the modern financial imagination, there is a persistent fantasy that the little guy, or at least the outsider, can beat the house. From the meme stock rallies of the 2020s to the crypto crusades against centralized banking, millions of investors operate under the assumption that if they just buy enough of a scarce asset, they can force a short squeeze, break the corrupt institutions, and trigger a massive wealth transfer from the elites to the people. It is a seductive narrative. It suggests that the free market is actually free and that the laws of supply and demand apply equally to everyone. But history suggests that when an outsider actually corners the establishment does not pay up. Instead, they rewrite the rulebook while the game is still being played. To understand the mechanics of this trap, one must look back to the inflation crisis of the late 1970s. The United States was suffering from a crisis of confidence. The gold window had been closed by President Nixon less than a decade prior, severing the dollar's final link to tangible value. Inflation was rampant, eroding the savings of the American middle class and destroying the purchasing power of heavy industry. In this environment of decaying fiat money, two Texas oil tycoons, Nelson Bunker Hunt and his brother William Herbert Hunt, decided that holding paper currency was a fool's game. They believed that a total dollar collapse was not just possible, but inevitable. The Hunts were not typical Wall Street speculators. They were ideological hardliners who viewed the Federal Reserve as a mechanism for confiscating wealth through inflation. Their strategy was blunt and aggressive. Trade their depreciating paper dollars for the one asset they believed was undervalued and historically sound: silver. Unlike the paper traders on the COMEX in New York, who bought futures contracts only to settle in cash later, the Hunts wanted physical delivery. They chartered airplanes to fly massive bars of bullion to vaults in Switzerland and the American West. They were removing the collateral from the casino, and this terrified the banking establishment. By 1979, the Hunts had formed an alliance with wealthy Saudi Arabian investors, creating a buying pool with virtually unlimited capital. As they swept up the global supply of silver, the price began to move with terrifying speed. Silver climbed from $6 an ounce to $10, then $20, then $30. By January 1980, silver hit a peak of nearly $50 an ounce. On paper, the Hunt brothers were the richest men in the world. They had seemingly beaten the central planners at their own game, but beneath the surface, the financial system was cracking. The major bullion banks and brokerage houses had sold massive amounts of silver they did not actually possess, betting the price would go down. As the price skyrocketed, these institutions faced margin calls worth billions of dollars. If the Hunts and their Arab partners demanded physical delivery of the silver they had bought, the COMEX would default, and Wall Street banks would collapse. The accumulation of metal had exposed the fragility of the paper market. The system faced a binary choice: allow the free market to function, which meant the bankruptcy of the establishment, or intervene to save the banks. The response was swift and brutal. In the frantic backrooms of New York and Washington, the regulators and exchange governors held emergency meetings. They realized that central bank power relies on the illusion that paper contracts are as good as gold. The Hunts had shattered that illusion. As January 1980 drew to a close, the exchanges simply changed the rules overnight. They announced liquidation-only orders, prohibiting anyone from buying new silver. Traders could only sell. The demand side of the market was artificially amputated by a stroke of a pen. The price of silver didn't just fall, it was pushed off a cliff. The Hunts, leveraged to the hilt, watched as their empire of metal turned into a prison of debt, unaware that the trap had already snapped shut. On March 27, 1980, a day now infamous as Silver Thursday, the trap fully tightened. As the price of silver plummeted by 50% in a single day, the margin calls hit the Hunt brothers like a sledgehammer. They owed more money than anyone had ever owed in history up to that point. But here is where the story reveals the true nature of imperial finance. The Federal Reserve, under Chairman Paul Volcker, did not intervene to save the Hunts. It intervened to save the banks that the Hunts owed money to. A $1 billion credit line was authorized, not to keep the Hunt family solvent, but to ensure they could liquidate their assets and pay off the Wall Street brokerages that had bet against them. The brothers were stripped of their billions, their silver was flooded back into the market to suppress the price, and they were dragged through years of litigation. The message sent by the establishment was crystal clear. You're allowed to speculate within the casino, but you're never allowed to threaten the solvency of the house. The silver crash of 1980 was not a market failure. It was a successful defense of the fiat money system against a challenger. It proved that in a battle between physical assets and the printing press has the ultimate advantage because the state controls the laws of the exchange. This historical blueprint is vital for understanding the modern global debt bubble. Today, the situation is mathematically far worse than it was in the 1970s. The United States debt has metastasized from mere billions to tens of trillions. The system is no longer just fragile, it is structurally insolvent. Investors today, sensing the same devaluation that the Hunts foresaw, are once again looking for exits. They flock to gold, real estate, and decentralized cryptocurrencies, believing they can build a lifeboat independent of the Federal Reserve. They believe that when the dollar collapse accelerates, their separate ecosystem of value will protect them. But the lesson of the Hunt brothers is that there is no such thing as a separate ecosystem when the state perceives an existential threat. The modern tool of control is known as financial repression. This is a strategy where the government deliberately orchestrates a negative real return on savings to liquidate its own debt. They keep interest rates below the rate of inflation, slowly bleeding purchasing power from the middle class to subsidize the state's liabilities. It is a slow-motion wealth transfer, invisible to the uneducated, but devastatingly effective. The danger arises when the public tries to escape this repression too quickly. If a modern asset class, whether it is Bitcoin, gold, or foreign equities, becomes large enough to destabilize the dollar's hegemony, the response will follow the 1980 script. It will not be a fair fight. Regulators can impose windfall taxes, ban ownership, or restrict conversion back into fiat currency. They can implement liquidation-only rules on crypto exchanges just as easily as they did on the COMEX. This brings us to the looming specter of a currency reset. As the current debt supercycle reaches its mathematical limit, central banks are preparing the next iteration of money: central bank digital currencies. A CBDC is the ultimate realization of the trap that caught the Hunts. In a fully digital, programmable monetary system, the central bank does not just control the supply of money, they control the velocity and the permission to spend it. They can prevent a run on the bank by simply turning off the ability to transfer funds. The tragedy of the Hunt brothers was not that they were wrong about the dollar. They were right. Their mistake was thinking they could beat the Fed in a game where the Fed owns the referee, the scoreboard, and the stadium. As we approach the turbulence of the late 2020s, the volatility will tempt many to try and corner the market or short the system. But history serves as a grim reminder. When the collapse comes, it will not be the speculators who dictate the terms of the new order. The reset will be designed to preserve the institution, not the individual. The house always wins, because the house writes the rules.